Hello, everyone, and welcome to our cash flow statement webinar. Thank you all so much for joining us. My name is Mallory Krieger. I am the Farmer Training Manager with the nonprofit The Land Connection, based in Champaign, Illinois. And for those of you who were not familiar with the Land Connection prior to hearing of this event, we work to grow the local food economy both on and off the farm for a healthy and resilient future. And we do that through a number of means. The primary means is through farmer training events such as this. So we host webinars, workshops, field days, and create and collect resources that we share through our website, social media platforms, and our newsletter. We also achieve this mission by hosting a farmers market where we help create market opportunities for farmers. And that farmers market is held May through October in downtown Champaign, and it is a midweek farmers market. So for those of you who are local, I hope that we see you next summer starting in May on Tuesday afternoons from 3:30 to 6:30. Some business of the webinar today. I want to ensure that everybody keeps their microphone muted, and that is to help with the sound quality for everybody. So we're cutting down on background noise. This webinar is also being recorded, and it will be posted to the Land Connections YouTube channel and shared with you later today by email. It will also be posted to our Farm Finances webinar series webpage on our website. And questions are encouraged during the webinar, and I ask that you type those questions into the chat feature. My colleague Sarah is here on the webinar with me today, and she will be moderating the questions and reading them aloud to the group. We will stop periodically throughout the webinar to answer questions. So type your questions at any time, and Sarah will compile them, and we will get them answered at our scheduled breaks. This webinar is expected to go for between 40 to 60 minutes, depending on how many questions are asked. And so we will dive into our topic for the day. First, I would like to acknowledge the funding that has made this webinar series possible. We'd like to thank our funder, Farm Aid. They have made it possible for us to offer this Farm Finances webinar series free of charge. So a big shout out and thank you to Farm Aid. Our agenda for this webinar is to explore what a cash flow statement is and why we create it. Essentially, the so what and the how. So we're going to go through the background of cash flow statement and its context within farm financial health. We'll explore the components and terms of the cash flow statement, followed by a step-by-step example of how to craft a simple cash flow statement, then analyze that information and point you to further resources that you can use to create a more robust financial health for your farm. Again, questions are encouraged, so please ask those questions via the chat feature. So the cash flow statement is one of the big three financial statements. Those are the balance sheet, profit and loss statement, and the cash flow statement. We have held webinars on the previous two already, and those are available through our YouTube channel and our website. I recommend that you watch all three to flesh out the whole picture of your farm financial health. Today's webinar is a standalone webinar, but it is nested in the context of both the balance sheet and the profit and loss statement. And I'll make connections within that context, but it is really beneficial for you to have an understanding of what the elements of a balance sheet are and a profit and loss statement and how they all fit together. Because the cash flow statement pulls information from both of those two previous financial statements to gain a new understanding and a deeper understanding of what's going on in your farm financial picture. So the balance sheet is comprised of assets and liabilities. It shows you what you have left if you were to sell everything in your business immediately, liquidate your whole business. So sell off all of your assets, pay all of your debts and liabilities. What do you have left? The balance sheet is good for comparisons on a monthly, quarterly, and yearly basis and builds the picture of what your net worth is. Are you growing your net worth or are you not with the investments that you're making in your business? The profit and loss statement looks at net profit. Did you make money or did you suffer a loss in any given period, usually a year? It compiles sources of all of your revenue and expenses to determine your net income. So the primary difference between a balance sheet and the profit and loss statement is that the balance sheet is assets and liabilities. These are things that hold worth or take worth away, and income and expenses. These are money coming in and money going out of your business. The cash flow statement is built of inflows and outflows. It's essentially saying how much and when is money moving through your business. That money could move through your business in assets and liabilities or in income and expenses. And in that way, a cash flow statement is kind of like a hybrid between the balance sheet and the profit and loss statement, but it's giving you different information in aggregate than either of those two previous statements. It is measuring your cash on hand. Cash coming into the business is called inflow. Cash going out of the business is called outflow. Any of the cash that stays at the end of your period is available for reinvestment. The cash flow statement is divided into useful periods, usually months. It is measuring how much money is available at any given time during the course of a year or a month or a week, whatever your measurement unit is that you choose, which is typically a month. Typically a year broken down by month. It records the timing of the cash flows in and out of your business and illustrates when that cash is available for investments or not available to pay liabilities. Farms can have a lumpy cash flow. When cash is flowing in a positive direction, it's called a surplus. When it's flowing in a negative direction, it's called a deficit. It's very common in farming to have a positive cash flow at the end of the season when crops or livestock are ready for sale, and a negative cash flow at the beginning of the season when the expenses are happening that are required to be able to create that farm product, to grow the crop, raise the livestock, and sell it at the end. The cash flow statement is particularly important to farm businesses because of the lumpy nature of that cash flow. So here is the first half of a cash flow template. On the next slide, we will look at the second half. The cash flow template is broken out into three main categories: cash flows from operations, cash flows from investing, and cash flows from financing. This first slide is looking only at the cash flows from operations. Operations is broken down into cash inflows and cash outflows. The other two categories of investing and financing are not broken down into in and out. The reason for that is because of the subcategories that are inside of operations. There are so many more of them than what happens with investing and financing. So if we look at the investing and financing slide, we can see between the two of them, there's only 6 subcategories. Looking back at the operations, there are far more. So we break out the operations into inflows and outflows to get a little bit more understanding of when cash is coming in and when it is leaving. The other elements of the cash flow template are these sub periods. So the example that we're doing today is for an entire year. We're looking at a fiscal year's cash flow for a farm. That is then broken down into the months, January through December, and then the total. It is organized the same way on the second half on the income or the cash from investing and financing. Investing is buying and selling things that retain value. So if you buy a new hay rake, that is an investment. That is a cash flow from purchases, which means you will be spending money. It's flowing out buying that. But say you have a piece of equipment or a parcel of land that you no longer have utility for. You could sell that, and that would be cash inflow from sales of capital assets. Cash from financing is the income or the inflow and the outflow of cash from any loans that you may acquire. So an operating loan would be a cash inflow at the beginning of the year, and then you pay that operating loan by the end of the year, and that's a cash outflow by the end of the year. Cash from financing will include both principal and interest payments on the loans that flow through your business. Another line that is in the cash from financing is the owner living / draw. That's the money that you pay yourself as the owner of the business. And it's considered cash from financing because you're essentially financing it with your time and then receiving money back for that investment that you put into it. So why would we complete a cash flow statement? Well, a lack of cash flow can put your farm out of business even if you are profitable by the end of the year. It is very possible to, on your profit and loss statement, have a net profit and potentially even a substantial net profit by the end of the year, but not have access to that money when you need it to meet your liabilities, to pay your bills. If you don't have money when you need it, it is possible to end up in foreclosure. So understanding cash flow is really important in determining if a bill can be paid on time or if there is money available to make necessary investments. It's also useful for comparing farm performance year to year. Today we will be looking at a retrospective cash flow from events that already occurred. Using old data from events that already occurred, you can create what's called a pro forma cash flow, and that is a performance projection for future years. That pro forma can be used to obtain more capital and more financing if you should need it. Creating cash flow statement also enhances trust factor with a lender. Lenders are looking to loan money to businesses that have a deep understanding of their financial situation and are able to communicate it. And by creating a cash flow statement, you demonstrate to that lender that you have an understanding of the cash flows within your business, and you can demonstrate to them that you have the cash flow necessary to service the debt that they may offer you. Additionally, cash flow statements are the most important of the big three financial statements for a new farmer. This is both from a personal perspective and from a lending perspective. It's imperative from a personal perspective that the farmer understands when money is coming into the business and out of the business so that they can meet their obligations. But as a new farmer, likely new farmers will not have access to large assets that can be used as collateral, and likely do not have substantial income yet built up to be able to finance their own growth. When trying to access financing from a commercial banker, they look at the cash flow statement to determine whether you can service that debt. And that is ever more important as a new farmer who doesn't have a long financial history to be able to draw on. There are some tools that are available for crafting a cash flow statement. You will be sent a paper template of a cash flow statement by PDF in your email after this workshop when you are sent the video. You can also use any spreadsheet software like Microsoft Excel, Numbers, Google Sheets to create your own cash flow template. You can also download free templates from an organization called Score. If you just go on to any web search engine and search for Score, business templates, cash flow template, you can download those easily. QuickBooks and other financial accounting software also are wonderful tools for calculating cash flow. If you are inputting your financial transactions regularly into financial accounting software, you can calculate the cash flow statement readily by going to the report section and just 2 clicks and you've got your cash flow statement. Very, very quick and easy. The challenge with using the financial accounting software is being on top of inputting all of your transactions so that you're able to gain that information readily at your fingertips. So it's work paid ahead for gains later. So we've reached our first question break. Sarah, are there any questions on what a cash flow statement is and why you would want to complete it?
Nothing's been entered yet. Does anyone have any questions you'd like Mallory to address more in depth?
Okay, well, please feel free to ask any questions that you may have as we go. Sarah will be compiling those, and we will stop shortly for the next question break in just a few moments. So diving in, crafting your cash flow statement. We will be walking through the process of gathering all the receipts for the period in question, creating a financial inventory and transaction log, which is sorting your assets and liabilities and income and expenses into relevant categories, entering that into the spreadsheet or financial software, calculating and analyzing. So that first step is creating a financial inventory and transaction log. Begin by making a master list of everything that has money attached to it with your farm. What did you sell? When did you sell it? What did you pay out and to whom and when? What do you own and what do you owe? So this is not just income and expenses, but it's also anything that you own that has value attached to it. If you own your land, what is the value of the land? Do you have improvements on the land like barns, fences, greenhouse? What is the value of those structures? Also, anything that you owe, credit card debt, operating loans, mortgage, equipment loans. Gather up all of that information. While you're gathering that information, consider every stage and element of your business, from the management and overhead, insurance, to every stage of production, your greenhouse or your farrowing house, growing in the field, investments that you put into the livestock from veterinary expenses, feed. What does it take to get your product to market and to sell that product? Any of your marketing fees, any of your transportation costs, farmers market vendor fees, delivery costs. Look to all of your receipts. Be sure to keep all of your receipts for your business and organize them into the categories that we will talk about in a moment. But it's from those receipts that you will be gathering the information that you need to sort your income, expense, assets, and liabilities into the relevant categories and into the relevant time period. Knowing when those expenses and revenues occurred is critical to understanding your cash flow. Without that date information, the cash flow statement is useless. It's no better. It gets you no more information than what you would already have from the profit and loss statement. So once you have all of those receipts gathered up, you're going to sort them into a chart of accounts. The chart of accounts is just a set of useful categories that you use to make comparisons and analyze your financial data. So income categories could be by product type, or they could be by market channel. It's totally up to you whether you choose market channel or product type, whatever you find the most meaningful for your business. Here's a list of an example list of categories for expenses. So think about marketing and advertising, custom hire, packaging, insurance. Again, whatever is the most meaningful for you in understanding what types of expenses you're incurring. I suggest looking to the IRS Schedule F for inspiration when crafting your chart of accounts. There are essentially only 4 required elements of the chart of accounts: assets, liabilities, income, expenses. What you do inside of those main categories is totally up to you. So the Schedule F is the profit and loss from farming form that you are required to file with your taxes at the end of the year for your federal taxes. This form has a whole section on farm income and a whole section on farm expenses. I highly recommend ensuring that the categories that you choose for your chart of accounts easily flow into your Schedule F, because you will be required to do the Schedule F, and it will be so much quicker and so much more simple if that chart of accounts flows well into it. So look to the Schedule F for some inspiration. As I mentioned before, the cash flow statement is somewhat of a hybrid, a cherry-picked hybrid between the balance sheet and the profit and loss statement. And so there are some sources of cash inflow that there are some sources of wealth or income that are present on the balance sheet and the income statement that are not present on the cash inflow. And that is because the cash flow statement is looking at cash money that has moved in or out of your hands, not held value. So do include sales of livestock products, crop, government payments, taxes, credits, and tax credits and refunds, crop insurance proceeds, sales of lands, loans received. In all of those categories, money actually moved into your business. Do not include things like the value of your land and the value of your machinery or other depreciable assets, because that is value that you held, even if it appreciated in value. So say you had an appraisal and in that year, your land increased 3% value. That's an increase in wealth, in net worth. It is not an inflow of cash. Money didn't move into your business. It grew within your business. So the cash inflow is something that you didn't have before that you could say almost physically moved into your business. Additionally, do not include non-farm sources of income if you are calculating a farm cash flow statement. Do include non-farm sources of income if you are doing a family cash flow statement or a hybrid. The hybrid cash flow statement would be looking at your farm business and your personal finances all in one picture. But do not include non-farm sources of income if you're doing a farm-only cash flow statement. Looking at cash outflow. Again, this is real money that moved, not book money that you gained or lost. So here's a list of examples of types of cash outflow. Do not include loss of livestock by death or loss of crop by weather issues or crop failure. Do not include the decrease in the value of machinery or depreciation expenses. All of those are very real financial things that are happening in your farm, but they're not relevant to learning about the cash money flow that you have at your hand to be able to pay your liabilities. So once you've sorted gathered up all of the information from your financial transaction log and your financial inventory, enter it all into the spreadsheet or software. We're going to pause for questions now. When we continue, we will actually work through the cash flow statement exercise so we can see how all of these moving parts fit together. But for now, are there any questions about categories of money that go on the cash flow statement and what does not go on the cash flow statement?
Yes, we do have a question. How important is it to detail non-farm income on a farm cash flow? Our bank's cash flow sheet has a place for our non-farm income, but we very much like to keep the two money pools separate. Am I not understanding the importance of combining the two?
So it sounds like your banker puts substantial value on the non-farm income, and that will come down to a conversation between you and your banker. I tend to agree with what I understand the asker was saying about wanting to keep personal and farm income and cash flow separate, and there's this whole school of thought about keeping them separate, that it's very important for the business to stand on its own. It really comes down to what the purpose you have at the time that you are filling out the cash flow statement. So if this is being presented to a lender who wants to understand your off-farm income, give them what they're asking for, absolutely. If this is for yourself to be able to understand if your business is standing on its own legs or if you're propping it up with investments from your own personal off-farm income, then keep them separate and record those investments as cash inflow from investments. Any other questions?
Yes, we have another one. Is cash flow also available in Quicken, which I use for keeping the checkbook?
I am not personally deeply familiar with Quicken, but I do believe that it is. But I recommend I can look into that and answer this question offline. If you can reach out to Sarah privately on chat with your email address, and I can look into that and get back to you. Are there any other questions?
Nothing entered at this time. Anyone have something else you'd like to ask right now?
Okay, well, we will continue on to the cash flow statement exercise. So up to this point, gathered up all of the receipts for this example farm have been gathered, and a chart of accounts has been created. The financial inventory includes everything that would be in the category of assets or liabilities. The farm financial inventory is the core source document for crafting the balance sheet. So it's assets and liabilities. It is what has inherent monetary value, what you own or what you owe. The transaction log includes all of the income and expenses, and it is the core source document for creating the profit and loss statement. Both the profit and loss statement and the balance sheet use a chart of accounts. The chart of accounts is universal for all three of these financial statements. For the cash flow template, we will start with looking at the cash inflow from operations. So recall that we have three main sources of cash flow. We have operations, investing, and financing. Looking at the operations only, we're going to look at the inflows. So this is money that moves into the business from your operations. That is primarily found on the transaction log in the income section. So we look at the transaction log income section and start sorting it into those accounts that are created by the chart of accounts. So CSA shares, farmers market, livestock sales, custom hire, government payments, and miscellaneous sales. This is the example. You can choose to organize your income accounts differently, but this is what we're going with for this example. So looking at the transaction log, we have the item, the month that it happened, and a calculation of the value, the quantity, the rate, and the total. All we need for the purposes of the cash flow statement is the item, the month, and the total. So we start sorting. The CSA shares go into the CSA shares bucket. Market steers go into livestock sales bucket. Hay bales into miscellaneous sales. Equipment repair services rendered goes in custom hire. The CRP annual payment goes into the government payments. And then all of the farmers market revenue goes into the farmers market. It's important to note what the month is that it happened, because when you are sorting it, you're putting the value into the appropriate month by category. So this is what the cash inflow from operations portion of the cash flow statement looks like once it is complete. We can see here that there are some months where there is no inflow from operations, and there are several months where there are decent inflow from operations. The farmers market has its highest months in July and August. Livestock sales occur only in October. The government payment comes only in December. CSA shares are sold at the beginning of the season. This is a very typical lumpy cash flow example. Farms have lumpy cash flows. So it's important to note when that cash is coming in. So when we calculate when it goes out, we know whether we have the cash necessary to service the debt or to pay the expenses. At the top of the cash inflow from operations, we have a line called beginning cash balance. This cash flow statement is for the fiscal year, so it's from January 1st to December 31st. That beginning cash balance is populated based on what the cash holdings of the farm was on January 1st at the beginning of the business day. So that would be any petty cash box, any checks that had not yet been cashed but easily are turned into cash money, and what is in any savings account or any checking account for the farm. One thing of note is we can see that the farm has a total cash inflow for the fiscal year of $50,680, so just shy of $51,000. So we'll move on to the outflows from operations portion of the cash flow statement. Just like the inflows from operations, this is predominantly expenses. So we will be looking at the transaction log expenses section to pull this information. Just like with the inflows, we look at the items, the month that it happened, and the total, and we sort them into the various cells of the spreadsheet. So the seeds and heirloom transplants go in seeds and plants. Compost and fertilizer bags go in fertility. And we keep sorting, going down the list until all of our transactions have been placed into the appropriate category. There are two types of expenses that are on the transaction log that don't have a place within the cash outflows from operations. Those are depreciation expenses and interest expenses. We will revisit depreciation and interest when we move on to the second half of the cash flow document, the financing and investment cash flows. So those expenses have all been categorized and placed into the appropriate month. And now we can see what the expense flow looks, the cash outflow from operations looks like for this farm. The first thing that I noticed when looking at this cash outflow portion is that every single month has expenses associated with it. On the inflows, there were many months that had no cash inflow. So that is very meaningful. It's very important to note that there are months where this farm will have expenses that have to be paid and do not have comparable revenue in the same period to be able to make the payment. The good news is, though, that the total cash flow for the year is substantially lower than the total cash the total cash inflow from operations is substantially higher than the total cash outflow from operations. The bottom right-hand cell is $28,028. That is the cash outflow from operations, which is much less than that roughly $51,000 that was flowing into the business. So putting the cash inflows on the same slide as the cash outflows, we can start to see which months we would have a deficit. The bottom row, where we have the red circle, is net cash from operations. That is the inflow for each month minus the outflow for each month. Where the cells have parentheses, that is a negative number. That means that is a deficit month. More cash left the business than entered the business. So we see January, March, April, May, June, September, and November all have negative cash flows. The remaining months have positive cash flows. And the total cash flow is a positive $22,652. That means that on balance over the year, more cash came into the business than left. So there is enough cash flow in this business to meet all of the expenses from operations. So that's really good news. The value of this portion of the cash flow statement is looking at when those expenses happen compared with when the revenue happens, so that the farmer can retain enough cash to service their expenses in the months where revenue is low. It's that perennial challenge of navigating the lumpy cash flow of a farm business. Now we will complete the cash from investing and the cash from financing. As we noted before, cash from operations was split into inflows and outflows because there are so many more accounts that are used for comparisons within the operations section. There are far fewer accounts that are used for comparisons in investing and financing. So we mark those down as positive and negative numbers rather than putting them into inflows and outflows. So we start by looking back at the transaction log, and recall we had two categories or two types of expenses that had not yet been categorized: depreciation and interest. The first thing to note is that depreciation is not a cash expense. It is a book expense. Depreciation is a very real thing that happens to finances in any business and must be accounted for to have a really deep understanding of the financial health of the business. But it is not relevant to cash flow because no cash actually changes hands. It's a measure of a change in market value of an asset. So for example, the truck. You purchase a truck for, say, $10,000. Every year, that truck loses a little bit of value on the fair market because it's older, it's undergone more wear and tear. It may be a perfectly operational truck, but I'm not going to pay the same amount for a 17-year-old truck that I would pay for a 3-year-old truck. That's depreciation. Depreciation is reflected on your other financial statements, the balance sheet, cash, profit and loss. That's where that lives. This is an example of how the cash flow is cherry picking. It's saying, I'm not dealing with depreciation because it's not cash money that changed hands in the year. So we strike off the depreciation. It's relevant on other financial statements, but not for the cash flow. The interest payments are relevant So we categorize those. They go into the cash from financing section. So the mortgage will go into the mortgage section. The interest for the operating loan will go into operating loan, and the interest for the hay rake loan will go there. Now you may be asking yourself, why is only interest here, but the principal is not? I have to make payments on the principal too. The principal will come on the next slide. The interest is on this slide because the interest lives in the expenses section of the farm transaction log. It's relevant to the profit and loss. That's why it lives there. These logs, the transaction log and financial inventory, exist the way they do because they help you fill out all three of the big three financial statements smoothly. So the interest lives here, but on the next slide, we will look at the principal. So this chart shows the cash flow from investing and financing for assets and liabilities. This is your financial inventory that's used to build a balance sheet. It shows everything that has inherent value on the farm, what you own and what you owe. Well, on the cash flow statement, we're only looking at things that cause you to have money leave your farm, cash money leave your farm in this year. So the value of the hay in your barn, if you sold it, that is cash flow in. And it would move off of the financial inventory and into the transaction log because it has then become income. But right now, this is physical hay that's sitting in the barn. It's not moving money. So it's not relevant to the cash flow. The only items that are relevant to the cash flow statement are your loan payments on this sheet. So we have 3 loans, and this is where we pull the information about the principal. So the mortgage is $1,000 a month. It goes into the mortgage payments. The annual operating loan is due in full in December, so it goes into the operating loan. The hay rake loan is $1,000 per year due in December, so it goes into the equipment loan. And this is the cash flow from investing and financing all filled out. We can see in January, the operating loan had a $10,000 positive cash flow. That's when the bank handed the $10,000 cash and said, here, operate your business for the year. Following that row all the way to December, we see cash outflow, a negative number in parentheses of $11,000. That's the combination of the repayment of the $10,000 principal on the loan and the payment of the $1,000 interest. That's the combination of the principal from the financial inventory and the interest from the transaction log. The mortgage payment occurs every month. There's the $1,000 of principal and the $292 in interest. So those are all laid out each month. And then the equipment loan is just due in December, and that's the combination of the $1,000 principal payment and the $120 interest payment. So looking at the cash from financing, we have positive cash flow in January and negative cash flow in every other month. The cash from financing is overall negative. The cash from investing, this farm didn't make any capital purchases or sell any capital assets, so there is no cash from investing to record on this cash flow statement. Now there is one other line, the living/draw. And as we mentioned earlier, it's important to pay yourself. This farmer, on this example, did not yet pay themselves. So nothing is recorded there. So let's look at the consolidated cash flow statement. This is the entire cash flow statement all in one slide. There's the cash inflow from operations, outflows from operations. Then we have line D, the net cash flow from operations. That is inflows minus outflows Then we have investing and financing. And at the very bottom, we have the ending cash balance line. That is line D plus line E plus line F. That is how much cash flowed through the business during that given month. So January has a positive cash flow. Looking at the next slide so that you can see it more clearly. January has a positive cash flow of $6,398. There are many months that have negative cash flow and many months that have positive cash flow. It's that lumpy cash flow. Overall, the ending cash balance is $5,032 for this farm. What that means is that $5,000 more money flowed into the business than flowed out of the business. The bottom line, net change in cash of $3,682, that is how much cash was gained over the year, over what you started with. So looking at the ending cash balance, it's important to note how much of an effect the financing has, the cash from financing has on the cash flow for the business. They have a fairly healthy outlook from operations, but once the cash from financing is taken into account, the farm takes a major cash flow hit over the course of the year. So it's critical to understand when the cash is coming in and when it's leaving to make sure that this farm doesn't get underwater on servicing that debt, because that mortgage payment is going to happen every month no matter what. It's also important to note that the farmer has not paid themselves. So there's only $5,000 left at the end of the year to pay the farmer. That $5,000 is cash that is available to be reinvested. It could be used to pay the owner. It could be used to buy a piece of equipment. It could be used to prepay expenses. That money is available for reinvestment. It also could be held for a rainy day. As we mentioned earlier, farms are subject to unexpected expenses. So that money could be held over to weather those unexpected events. So some key questions to ask when analyzing your cash flow statement. Is there operating revenue enough to cover operating expenses? Capital purchases and sales, how much did that affect the cash flow? Did you pay down the principal on debts, or did you take on more debt? Did you pay yourself? And after all the obligations are considered, is there enough cash left to provide a cushion for unexpected events? Are there any questions from the listeners on assessing the value of assets and liabilities and filling out the cash flow? I'm sorry, that was my notes are off on this one. Are there any questions about filling out the cash flow and analyzing the cash flow statement?
Nothing entered yet. Anyone have questions you'd like addressed in more depth?
Okay, well, we will have another opportunity very shortly, so if you do have questions, go ahead and type it into the chat feature. I will just take a moment to point you to some next steps. So Sarah will be sending out a link to our evaluation for this webinar using the chat feature. You will also be sent the evaluation by email with the recording of this webinar. Please do take a moment to complete that evaluation before you leave your computer today. We are grant funded by Farm Aid, and it is very important for us to be able to demonstrate to Farm Aid the impact that their investment has. they're looking to help create more financially viable farms, and we need to help communicate to them that their money is going, how their money is being used. So this evaluation is a really important tool for us to be able to communicate with Farm Aid and to be able to continue to offer these webinar opportunities, particularly for free. I also point you to the link here, the landconnection.org/farmers/resources-0. That link points to the other webinars that have been created for this webinar series. So the balance sheet and the profit and loss webinars are available there. I also want to encourage you to mark your calendars for February 6th. We will be hosting a webinar on a practical guide to QuickBooks. So we have an accountant who works with small farmers every day at their bank, and they will be talking about how to use QuickBooks to better your financial understanding of your farm and to increase the health of your finances on your farm. I'd also like to point to some other resources that are available that I personally find very helpful. Fearless Farm Finances is a text written by Moses, which is the Midwest Organic Sustainable Education Service based in Wisconsin. And this book is the complete guide to managing farm finances. A lot of the information that was presented in this webinar today was derived from this, also compiled from some other sources, but this is an excellent book. It is available for purchase through Moses's website at this link. I also highly recommend a book called Building a Sustainable Business that is published by SARE, which is Sustainable Agricultural Research Education. They're primarily a grant-making organization funded by the USDA, but they have also commissioned several excellent books, and I highly recommend this one. It covers more than just finances. It is all about developing a business plan and marketing plan and building a robust picture for the growth of your business by setting goals, understanding your values and the values of other decision makers in your farm. So it's an excellent book. Are there any questions, Sarah?
Nothing new has been entered. Last chance for any questions.
Well, thank you all so much for listening today. If you do have any questions or any advice that you are needing, please feel free to contact me. I have my contact details up here on the screen. If I can't answer your question, it's very likely that I know who can, and I can help connect you to resources and to professionals who can answer your farm financial questions. So thank you so much for joining us on this webinar today. I really appreciate your time, and I wish you all well in this winter season of financial analysis for farms. So best wishes, and please do reach out if you have any needs or questions. And I hope that we will see all of you return on February 6th for our Practical Guide to QuickBooks webinar. Thank you all so much.